Peter Rose, Longwood Currency Trading. Dry powder will make you more money than if you had your money in the position. What I mean by that is you should always have reserves when you trade. Now, I understand when you're trading 3 mini lots or 2 or 3 full lots or something, there's no such thing as dry powder. You're all in, you're all out, and you're learning your craft. But what I'm trying to present to you, because I'm addressing the 4-figure to small 5-figure account trader that is looking to trade a 6-figure account someday. And so you need to learn the things that you'll be faced with so that you can prepare today mentally to do those things, to execute on that. That's not to say that you're going to have dry powder as a low 5-figure account. You're going to be going all in and all out. That's what you have to do in order to make money, in order to not get too greedy with the stuff. You have to make a decent wage from your money. Excuse me. You know, if you can average out 10 pips overall over your trading period, that's your profit. On a $30,000 account, that's $300. That's a lot of money a day. And so once you start getting comfortable with being able to do that consistently, maybe just $100 a day on a $30,000 account, that's still a lot of money for the size of the account, right? You can then say, gee, I'm going to sell that truck, I'm going to put another 10 grand into my account, I'm going to put another 40 grand into my account, whatever it is. Look, if you're going to go out and buy a house, you're going to have to come up with $70,000, $80,000 to buy a house. So come on. These are skills that you're learning to bring you an infinite stream of money as big as you have a bank to finance. And so the thing that you need to be aware of when you're learning the currency trading as a skill in that 4 and low 5-figure account development is that you're not trading to make money. You're trading to learn how to establish a reasonable number of pips that you're capable of gaining for your expectation on a trade. So if you're setting, if you find that you're setting a 30 pip profit target, but you're only getting consistently 8 pips, then you could go in and trade opportunities where you're only getting a 15 or a 20 pip potential profit target. You don't have to wait as long in order to find a trade, because you know more often than that you're just going to get 8 pips out of the trade. Just get 8 pips out of the trade. That's almost 1% per $1,000 that you have invested. How do you beat that? You can't beat that with a stick. But when you get up into trading to the point where you can stage, or you're adding lots because of compounding and stuff, then other things begin to take hold. You're not just trading for pips at that time, you're trading for the dollar value that the position is going to give you. And if you're constantly getting 8 pips on a trade, on average, over all the trades, you get 8 pips, then you can safely say, well, I'm trading a $100,000 account, I'm using $6,000 for margin, I've got $4,000 of dry powder on that particular lot, and I can make $800 easily on that if you can get 8 pips averaged out. Most of us averaging out over everything, you're probably not, until you get more experience, going to get more than 3 to 5 pips on average over every trade. And so therefore you have to say, I'm going to put this trade on, it's got to be really good, and the end result of that over the long run is going to be 3 pips. So that 3 pips can be at $30 a pip on a 3 lot. It could be $300 on a $100,000 account. So the purpose of the dry powder is to say, look, I've developed my craft on this $30,000 account, and I'm ready to go up to, let's say, $80,000. Well, you don't want to be trading $80,000 because you're making pretty good money on the 30. So you continue to trade the 30, but then you expand your profit target search to maybe the 15, 20 pip profit target to a 30 pip profit target. You're basically doubling that or increasing it by 2/3. Because what's going to happen is when you get to your get to that profit target, then you might have gone ahead and staged in a little bit and brought the average price up to the point where you can set your stop and get out and make a couple of $100. But after that, if the price keeps going, now you're going to be adding lots into the situation, and how far will price go in your favor? You don't know that. Now, I've shown before, and I've talked about this and talking about staging, and the ultimate decision that I'm going to tell you is that I don't like staging, because staging is doing it on a consistent incremental basis, paying attention to where that average position value is. There's a little bit better twist to staging that I use, but I don't want to complicate life any more for you than it already is. But the point is that you're staging, let's just call it adding to the position as it continues to go up. How far could it go up? Well, let's say you're adding in one full lot increments. So you're getting $10 a pip for every lot you put in. So let's say you add a lot and it goes up and then it goes against you 10 pips. You've lost $100 on that last staged in lot. So you get out. You lost 100, but you've accumulated all these other lots to that point, and so your average value could be 20 or 30 pips below that, and now you're getting 7 or 8 lots. You do your original 3, and then you pull them in, and so now you've got let's say you've got 8 lots that you've staged in. So now you're at $80 a pip, and yes, the prices come back against you 10 pips or 15 pips when you close the trade out, but now you've got a 20 pip spread margin at 20 pips times $80 a pip. It's $1,600. So that's what the dry powder is for. Is that once you go beyond your profit target, you're going to start staging these things in. And the reason you want to go beyond it is because you want to bring your average cost up to the point high enough so that you can set your stop and have a guaranteed payout of that amount of money. So that's where you're getting your safety net. And then you just stack them in from there, realizing what is my loss that I'm going to be taking? What am I willing to lose? If I'm staging 3 lots in at a time and I'm going to take a 20 pip retracement, I'm losing 20 pips against that 3 lots. I'm losing $600. If I've staged 2 of them in, I may lose $800 by the time I get out of the position. And so you've got the dry powder that you can use to power that trade beyond. I was in a trade the other day and I got out of it. I had my I made $1,000. That's fine. I'm done for the day. That thing went on to go up 100 pips beyond where I was at. I simply didn't want to take the position. It was a Friday, and I didn't want to go into the weekend carrying a carry trade and all that other stuff that could have gone wrong. And in fact, it went 100 pips up, and then it came back down 80 pips, just like a stone. So if I would have been in there adding lots in, I would have caught that, and I would have lost maybe my last 2 adds, and I would have come out way ahead because I had made $1,000 to start with, and then everything after that was gravy, right? I could have made probably another $600 or something like that, because I would have had the dry powder to do that. So the less money that you have in your bank to trade, the more you need to go all in so that you're maximizing those gains. If I go in with 1 lot, let's say I have a 10 pip profit target. I go in with one lot, and then at 5 pips I stage in another lot. My average value is 5. I'm going to 10. I'm getting 5 pips on 10, but I had to go to 10 in order to do that, where I could have just gone in with 2 to start with and go to 5 pips, and I'd make the same $10, right? So, or $100. So your importance in when you're going to start doing this fancy stuff is predicated on how much money you have as dry powder, because you always want to have dry powder. Number one, as a risk management thing, so if the thing spills out of control against you, or you go out to get a cup of coffee and you don't have your stop in very close and it drops 80 pips or 100 pips and you get stuck, you're okay, because you can sit there and wait underwater thousands of dollars because you went into the position with full knowledge of what was going on, and so that should retrace and go back. Now you may have to carry it over for 3 or 4 days, but you're still going to have it go back and you won't lose that money. So having that dry powder gives you risk management control. And second to that is you don't know how far that price is going to go. You know what your risk tolerance is on entry, right? You get a 10 pip stop or 20 pip stop or whatever you're comfortable with, and you get out. And you have control over that. But you don't have control over how far that price is going to go up. That price could go up 10 pips over your initial profit target that you had identified. It could go 30 pips over. It could go 300 pips over. It could be a major swing. You don't know. So how would you feel if you had 15 lots after you'd done your initial profit target, and you had 15 lots left, and you could have staged those in all the way up and followed that up if you'd have had 25, and then you stage in the 15, but you're still going with another 10. So don't be in a hurry when you get to the larger bank sizes to get all your chips on the table, because number one, you could lose those chips or a big portion of them. Second of all, if you're doing your trading correctly, the amount of money that you make with a standard position that you're taking, leaving a lot of dry powder, whether that's $300 a day or $500 a day or $1,000 a day or whatever that is, as soon as you hit that target, what I do is I close out, because I've identified that target as reasonable for that particular movement. Now I see that thing continuing to scream on. How it screams on, I don't know. I can re-enter the trade, or because the momentum is increasing at my profit target, I'll just hang with it and I'll trail my stop really close to that. So I'm ready to add to it. You just don't want to do any of that stuff until you get beyond a certain point. The price has gone a certain point, beyond your entry point and beyond where your normal operations, your normal trading operations, what you would call your normal position management. Because you have 2 stages of position management. You have position management that happens between where you go into that stage after the entry analysis and entry part of the trade to the profit target. That's position management 1. Your position management 2 is if that trade is going on beyond the profit target. There are other factors that you need to consider, other risk management techniques that you need to employ. And so when you're learning how to trade, you don't have that complication. You go all in with your 3 full lots and you come all out at 10 pips and you make $300. I mean, it couldn't be any cleaner than that, and it's a lot of money. You try to make 800 if you can, if it'll run or whatever, but you only have one thing to worry about. You're not changing your average price or anything like that. You've gone all in and the thing is doing a runner for you, and you're just going to hold it for as long as it'll go. And in the end result, because you have everything that you've got on it early, then that money is, every pip that goes up is $30 a pip, right? Whereas if you were staging that in, you'd still have $30 a pip, but 20 of it maybe down here so that you get this amount, but the other 10 is going to be at this stage point where the average price is, and you're going to get less on that last lot than you would have if you would have had it down at the entry level. And so you're reducing your profit target to a predetermined, you're reducing your profit from the trade from your original profit target by adding lots to it. It's only when you get past the profit target that you need to start adding lots or start using your dry powder, because at that point the initial happiness that you've had, you're trading, let's say you were trading 3 lots and your happiness is to get $300. Well, once that price goes beyond the point where you can lock in that $300 profit, now you can start backing up the truck and loading a bunch of stuff in because you set your stop such that you've protected the $300. So if it all goes to shit against you, you've made $300. It was a nice try. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.